What if I told you I have been able to successfully predict the future on 1,000 investments over the last 10 years? And this isn't some magic ball trick, it's based on data and numbers. So here's the problem. So many of us, when we're investing, we get emotional when in reality we need to base our investments on facts and figures. In this video, I'm going to break down exactly what I do to predict the future and more importantly, how you can steal my strategy and do it for yourself. In a moment, we're going to jump into a piece of software called Lendlord and it's completely free. I've put a link below. Click on it now, open up, because I want you following along with what I go through and why it's so important. The reason I use Lendlord to analyze my deals rather than a spreadsheet is for two reasons. Number one, on a spreadsheet, you've done your research already and your analysis already, and then you're just putting it in and making sure the numbers make sense. Whereas on Lendlord, all I need to do is plug in the address, the purchase, and the rental amount, and it extrapolates all of the information that I would need to do manually at a click of a button. Number two is that over time it will gather information on me and the type of properties that I'm looking for, and then the algorithm will go across Rightmove, Zoopla, on the market, auction houses, and bring all of those properties into one place, making daily recommendations that match my criteria. So now we know why we're using Lendlord. Click the link, make sure it's open, but before we go into it, what are the three things we need to look for? So number one is the numbers, fairly obvious. And I say fairly obvious because for 99% of people, that's all they look at. They look at the numbers on the screen and they go, that looks like a good return, I will invest in that property. So when I say the numbers, we're going to look at yield, we're going to look at net rental income, we're going to look at capital growth, but most importantly, something called IRR, the internal rate of return. I'll get to that in a second. But you need to be thinking about what the numbers mean to you. And this is where it's actually deeply personal. I'll tell you what I do. I look for a teen. And what I mean by that is 13 or more plus percent IRR. We'll get into that in a second, but the simple version I like to call combined return. So you need to know your numbers and understand what is the single most important number for you. And I'm telling you right now, it's the internal rate of return, or what I like to call a combined return. Number two is your area. The property's value doesn't go up because of the property. I know this is really weird. You've got the deal that's today. Does it make sense? Are the numbers looking good? But that doesn't mean it's going to be good in 5 years, 10 years, 15, 20 years, or when your kids inherit the property when the eventual happens. What does is the area. We're talking about the local economics. Is it, what's the crime in the area? What's the employment in the area? What's the opportunity in the area? What's the supply versus demand in the area? And all of these factors contribute towards the long-term growth of the property. And what you're going to see when we go into the analyzer is how you create true wealth in property isn't actually from the rental, it's from the growth of the value of the property, which is based on the area economics. So number three. What's the most important and why it's most important? I want you to think about London right now. At the time of filming this, we've had a lot going on. We've had Russia leaving the market, kind of with what's going on there. No opinions to be shared here. But that was a huge amount of the investment in London. And a lot of investment in London is based on supply and demand. If you think about it, it is the single most popular destination in the world. There is nowhere near enough property in London to factor in the demand. So why is it property prices since 2014 at an all-time high has dropped by 20%? And in fact, in the last 12 months, London has dropped 5%. The economics doesn't make sense. They're great properties. We've got supply restrictions. The local economics are good. And it's because of the number one thing in property investment, the household income. See, the average local household income in London versus the price is 12x. That means the average property is 12 times the average household income. How is that to be? Well, it's because a lot of London's growth isn't because of locals, it's because of external investors. And with millionaires leaving the UK and a lot of the foreign investment leaving London to go further up north, the affordability is a major factor that most people don't look at. But it is really important. It can be a perfect property in a perfect area with all of the economic support in it, but if you ain't got the fucking money, it don't mean shit. So you got to know your numbers and what they actually means, focusing on internal rate of return, and we're aiming for that teen figure or higher. Next is your area. What's going to make the property go up in value is not how pretty the house is or the tenant in it. It's going to be the local demographic and economics, and most importantly, what is the household income? It can be perfect in every way, but if you can't afford it, the numbers aren't in your favor. Let's jump into Lendlord and see this in real time. So we're in Lendlord's platform right now. There's so much that it can do, but explore it on your own and I'll do more videos. I really want to focus on what makes a great investment. And if you haven't clicked on Lendlord yet, make sure you do it now or after I go through this so you can follow along with your own investments. On the left, you've got 3 core categories, which is invest, manage, and finance. And we're going to click on invest, and then we're going to go down to the deal analyzer. And what we're going to do is it gives a very simple face like this. We're just going to put in the address, which on this property is 17 Wincover, and then Wincover Drive there. So we're going to go on today's valuation, which we're going to say is 165,000. And then the current rental is 825, and we're going to buy it, we're going to assume, with a mortgage on this. Now, look how instantly that comes up. And the first thing we're going to do is focus on the numbers. Now, look, you can go through this, the return on capital, the net cash flow income, and the further you flow down, the longer it gets, where you can see the growth in the market. Now, bear in mind, I've not put any figures in apart from what I'm purchasing at as a rent, and in the background, at a click of a button, it is extrapolated what the capital growth is in the area, the long-term ROI, and what I want you doing is just this quick shot here, the long-term IRR, the internal rate of return. Now, I mentioned this being one of the single most important metrics that I like to look at, and what I'm looking for quickly is it 13% or above? And you can see on this property is 15.52. So I already know based on the numbers that this is very likely to be a strong investment to go for. So what is IRR? In short, here's what it means. It is your rent, your rental growth, and your capital growth all factored into one calculation, so it gives you the real return of this investment. So now we know the numbers make sense. The next thing I really want to know is the area, and I'm going to do that by clicking on Postcode Insights. So let's go through this and I can show you some of the really important data. So first of all, notice how property doesn't go up every single year. We've had some growth years at 11.2%, 12.7%, and then post-COVID and the lull, we had it decrease and actually lost money in one year. Property doesn't go up every single year, and we factor this into our data. The next thing I like to look at is the crime rate. So I don't mind if it's average or below average. Most areas are average, obviously, but I'm going to look at that. Even if it's a bit higher, it doesn't turn me off, but it is something I'm going to factor in. I'm then going to look at the general election constituency, which is good to know where it's going. It's a pretty balanced portfolio here of 44% Labour and then 43% between Conservatives and Reform. And then the big thing I'm going to look at is schools in the area. So there's a lot of different schools in the area. I'm going to go down them. And the main thing that I want to be looking at is, are there any good or outstanding schools in the area, which there are. So these are the area stats. You can take your pick of what you think is more important to you, but I just want to know what's going on, and then I'm going to quickly look at the comparables just to sense check it. Remember I said that we believe this is worth 165. Well, it's revalued at that, so it definitely is. But I'm always going to look at comparables and just look at these numbers as a quick thing. So we've got a couple below, which are 105. So I'm probably just going to open those ones up in a new tab. But you can see pretty much everything else on here is above that. And then you've got some freak instances of a small industrial unit, not interested in that. 170, 195, 190. We can feel relatively confident in these figures. Final thing we're going to do is go back to Postcode Insights, and we're looking at that household income. Now, remember I said London, the reason why it's going down is because of household income. It's on average 12 times the average income. And this is what I'm looking for. Anything that is between 4 and 7 times household income is going to give you a good investment range. And what I mean by that is, yes, the economics can be on your side, everything looks good, but can people actually afford to pay the higher price range? Well, right now, the household income on this postcode is £36,500, with the purchase price being £165,000. And so that is less than 5 times the household income. In fact, it's around 4.5. If that isn't making sense, what that means is, if we know that people can afford up to 8 times, but I really like putting the threshold up to 7 times, theoretically, if we just jump on our calculators right now and we do 7 times 36,300, is 254. And so based on today's figures, the range of affordability, not that it will suddenly sell for that, but today people can afford this property at 254,000. And so from an affordability point of view, I've got so much range to go up to. And so the economics are on my side, the numbers make sense, and people can afford to go further. So from this very quick analysis in 3 minutes, at a click of a button, I now know the numbers make sense, the area is good, and people can afford to live here for the future. This is a winner. The other great thing is, now that Lendlord has that information on me and the property, number one, it's going to start showing me more opportunities that tick my box and make me tick, which is amazing, and that's going to get better and better in time. But on top of that, it's also going to start giving me lending options, which again, I can do manually. But instead of me picking up the phone to my mortgage broker and going, what are the current rates? It's doing it in live time, finding me the best finance for the property so I can execute quickly. Because the number one thing your vendors expect is speed and certainty. I hope you got value from this video. This is a little insight in the power of the software that can really make a life change. And for me, if I had this 10 years ago, it would save hours and hours of my time. So using the tools that I've just done today, we've been able to accurately predict the future on over 1,000 transactions. But my hope is that it helps you do it on your first deal today.